Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined by Chris Huemmer, Senior Investment Strategist at FlexShares Exchange Traded Funds. How are you doing today, Chris?
I'm doing great. How are you doing, Aaron?
I'm doing well. Let's do this. With inflation on the minds of many investors' lists of concerns, what are some ways that we can look to protect against it?
Hey, Aaron, really the way that we look at it is there's no one singular magic bullet to help investors solve for inflation. Our view is that it's a multi-horizon solution that we tend to look at. So using multiple asset classes. So on the short end, we prefer TIPS, Treasury inflation protected securities, as a great tool to hedge against inflation. However, going beyond, say, 5 years, TIPS, really the correlation with inflation or CPI tends to break down. And the reason for that is the coupon or the interest rate component of total return overwhelms that inflation component. In the intermediate window, say 5 to 15 years, that's where we would look at commodities and natural resources as tools to use in that intermediate bucket to pair with that short bucket of tips. Our preference, or my preference, would be more for natural resources over commodities today. There's a couple reasons for that. The one, from a natural resource perspective, there's more, you can access more areas of the natural resource complex that don't have futures or forwards contracts on them, particularly in mind timber and water, where you can invest in timberland and you can invest in utility companies or water companies. You can't invest in those from a futures contract. I guess you could do timber, but there's a few contracts out there, but really it's not as robust as, say, energy or agriculture or metals or precious metals. But there's a few out there, and then water, there really isn't any. So really, to get true access to those areas, natural resource equity does a much better job of that. Secondarily, I would say that the inefficiency with having to roll contracts from month to month, or and to balance that, really is in my opinion inefficient, because typically the curve is in contango, meaning that future future contract prices are higher than current prices. So every time you roll that contract, you are losing return. And then the other thing is, even in today's environment where, most investors, and if you look how the future curve is priced today for the Fed on the Fed rates, that we'll see, the investors are predicting multiple increases this year. Still, income is key, and natural resource equity. The nice thing is, because you're investing in equity, you get that income component as well. So those are the reasons we like natural resources and the intermediate. And then on the long end, global infrastructure, global real estate, common stocks are all good tools to blend together with tips and natural resources to really get that good inflation protection across the curve.
Great. So how can real assets enhance the traditional stock bond asset allocation?
Yeah. That's one of the really cool things about real assets. And typically when I talk about real assets, it's natural resource equity, infrastructure, and real estate. And what I like about each of these asset classes is they really have different and distinct return streams than global equity markets. They are all equity-based products, but because of other sensitivities to macroeconomic factors, they offer a different experience in an asset allocation model than just pure equity exposure. For example, if you think about infrastructure, you tend to see that infrastructure assets and infrastructure companies tend to have a sensitivity to changing in interest rates, very similar to bonds. A lot of that comes from when you think about established infrastructure projects. They tend to be very long-term projects that have predictable expenditures and also fairly predictable cash flows. And so they tend to kind of get traded very similarly to a bond. And because of that and the leverage that is inherent in a lot of infrastructure projects, they tend to have that sensitivity to interest rates or term exposure. Similarly, from a real estate perspective, you do see obviously a sensitivity to interest rates as that's a key component to real estate investing, but you also see exposure to credit spreads that you don't see with infrastructure. So where infrastructure really has term risk, global real estate has term and credit risk. So where as credit spreads tighten, you tend to see that global real estate tends to benefit from those situations. And then natural resource equity is really different. It doesn't have that term or credit exposure. You have that sensitivity to changes in commodity prices, which is why we like it as kind of in lieu of commodities in that intermediate term inflation hedge. But it also has exposure to emerging market growth expectations. So what this does is, and what each of these asset classes do, and when you combine them even more so, they have a return stream that's distinct from either global equities or fixed income, and that could lead to increased diversification across the entire asset allocation.
Great. Well, another attractive component of real asset strategies is the dividend income typically associated with these asset classes. How does income generation play into the total return of these strategies?
Yeah, and Aaron, yeah, I absolutely agree that the income component from real assets should not be overlooked. One of the additional benefits we find in the current low rate environment is the ability of these asset classes to deliver dependable income streams. We talked about natural resources versus commodities and the benefit there already, but when it comes to you see the same thing from real estate and infrastructure. So if I look back over the last 10 years and I look at global real estate, and you look at that from a total return perspective, 45% of the total return of global real estate over the last 10 years has come from dividend income as opposed to capital appreciation. It's even more so when I look at global infrastructure, where you see 52% of the total return over the last 10 years is coming from dividend payments compared to capital appreciation. So both of those are really powerful and show really the benefits of dividends. And those were in periods where markets generally have trended up over the last 10 years. As we see volatility increase, those dividend payments can act as a stabilizer in these periods of equity market volatility. And for a lot of investors, not just those who are seeking income as maybe a supplement to what they're getting from the fixed income portion of their portfolio, but for investors who are still looking to grow their assets and looking at it on a total return basis, that dividend income could be a stabilizer in their portfolio in these periods of volatility as well.
Well, thank you, Chris. We once again appreciate your insights and look forward to chatting again soon.
Yeah. Aaron, thanks for having me. Look forward to doing it again soon.